All right, hello everybody, good afternoon. Just a quick note here, this presentation is being recorded. Important notice, so please be sure that your attendance and any participation in this meeting is allowed under the policies of your firm. All right. So with that, we'll go ahead and get started. Good afternoon everyone, and welcome to today's webinar series on commercial premium financing. Your hosts today are myself, Martin Smith, and Joe Sienna. We are Advanced Markets Consultants with the John Hancock's Advanced Markets team. Before we get started, I just want to let you know that everyone will be in listen-only mode. We do have a lot to cover today, but if you have any questions throughout the presentation, we encourage you to type them into the question and answer feature, which should appear when you hover over the bottom portion of your screen. Time permitting, we'll answer as many questions as possible at the end of the webinar. If you have any questions that we don't answer today, we ask that you please feel free to give us a call at 888-266-7498. And thank you for your time today. And with that, let's get started. So commercial premium financing has been a very popular topic of late, especially with lending rates being as low as they currently are. So what is premium financing? Premium financing is a way for high net worth individuals to pay premiums on a life insurance policy by borrowing money from a third-party commercial lender. Most oftentimes, this policy is going to be held in an irrevocable life insurance trust or an ILIT, and the loan arrangement is between the trust and the commercial lender. The trustee of the ILIT is going to apply for the loan with the lender. The lender is the one who's going to establish the loan rates and the terms of the loan. And those rates typically vary annually based upon some index, such as the LIBOR or the prime plus a spread, and that spread is going to be based on the credit of the grantor. The grantor is also going to personally guarantee the loan repayment, and usually the loan interest is paid each year to the lender by the trust. If the trust does not have any liquid assets to pay the interest, the grantor may make gifts to the trust so the trust can pay the interest. Oftentimes, the life insurance policy cash values are used for collateral, and any shortfall in meeting those collateral requirements may require using additional trust assets or external funds as collateral. The commercial loans will be repaid either using the policy cash value, trust assets, personal assets, policy death benefit, or some combination of those. So Joe, why would we use commercial premium financing to pay life insurance premiums? Hey Joe, I'm going to unmute you here. Sorry guys, looks like, there we go. Joe, can you?
Thanks, Martin.
Yep, go ahead.
Thanks, Martin. In the high net worth space, premium affordability usually is not an issue. The issues with funding large premiums most times revolve around income or gift tax efficiency, as well as opportunity costs. So some of the reasons why high net worth clients look to commercial financing is, well, one, leverage and gift tax efficiency. That means that you're basically making a gift of just the interest on the premium certainly is less than making a gift of the entire premium. Number two, reduce income tax costs. Borrowing the premium eliminates the need to liquidate taxable investments in order to make these large premium payments. Third, arbitrage. Keeping these high-yielding assets at work allows them to take advantage of the low interest rate environment by just paying the small loan interest amount on the premium and keeping these assets at work. And of course, lack of liquidity. During periods of short-term or long-term liquidity needs, premiums can be funded at a low interest cost. So, why now? Let's just take a look at the next slide. Right now, we have a perfect storm of low interest rates as well as a period of economic recovery. LIBOR and Section 7520 rates are at historic lows. Assets that may have been devalued during the recent market downturn may have begun to recover, making the spreads between asset yield and debt service fairly dramatic. As you can see from the slide, just looking at the past 6 months, LIBOR has gone from 2% to about 45 basis points. Same with Section 7520 rates. And these are at all-time historic lows. So the opportunity to use commercial financing and this leverage as a means to take advantage, may never be better. Now, there's more than a few ways to structure a commercial premium finance case. We're going to go over a few of them during the rest of this webinar. So Martin, let's talk about a few of the considerations before we get into actual case design. What are some of the things that we need to address or take into consideration when we design an efficient commercial premium finance case?
Thanks, Joe. Yeah, some of the, whenever we're looking at selling life insurance to high net worth individuals, it's important to examine the client's, financial profile. Are they liquid, or does their portfolio consist mostly of, illiquid assets such as real estate or business ownership? How much gifting capability do they have? How many crummy beneficiaries do they have? Have they used any of their lifetime exemption? Obviously we want to look at their age and the potential risk class for purchasing life insurance. When designing a premium finance policy, one of the most important considerations is the loan exit strategy. Do they plan to repay the loan during their lifetime? If so, where are those funds coming from? Are they coming from a life insurance policy cash value, other trust assets, possibly a GRAT or a CLAT or another outside source of funds? Or do they just wish to use the policy death benefit and then have the loan repaid at death? Excuse me. If there are existing trust assets, what do those assets look like? Are they liquid assets? Are they business interests? What is the growth rate and income rates of those assets? So now let's take a look at one of the more talked about premium finance designs, using the policy cash value as the loan exit strategy. Now, this is probably the most popular premium finance design. So if you've heard about commercial premium financing before, this is probably what you've seen. One of the benefits to this overfunded design is that the exit strategy is built into the policy design. The life insurance policy cash value will be used to repay the commercial loan balance during the client's lifetime. The benefit to this design is that the client will only have to make premiums or gifts each year equal to the loan interest versus having to make payments or gifts equal to the entire premium amount. The client will have to post collateral for the loan. If they intend to use the policy cash value as collateral, any shortfall in collateral requirements will require additional collateral using other assets. Let's take a look at how these policies are designed. To accumulate the necessary cash value, the policy needs to be heavily funded. Usually at or near the maximum allowable funding without becoming a MEC or a modified endowment contract. When taking a distribution from the policy's cash value, the net death benefit will be reduced by the amount of the withdrawal. So using an increasing death benefit or ROP rider will be needed to make sure we're netting the desired death benefit. So let's go ahead and take a look at a case example now. All right, so in this case, we have a female, age 50, preferred non-smoker, looking for a $20 million death benefit. We're going to use the accumulation IUL in order to build up as much cash value as quickly as possible. We're going to do a 10-pay design with a premium of a little over $871,000. This is a heavily funded amount, so again, we're trying to fund this as much as possible to build up the cash value as quickly as possible. So we want to show a withdrawal equal to the premiums paid because that should be equal to the amount of the outstanding loan balance. The earliest we can show the withdrawal basis in this particular case is year 17 and still keep the policy enforced. In this case, we use the core capped index rate of 567, and we use the vitality bronze status. And when we look at the IRR on this policy, on the policy premiums, we look at a life expectancy, which in this case is year 38. We have an IRR of 5.4%. 0.04%. So we also assumed a loan interest rate on this design of 2.5% in year one, and increased it by 20 basis points annually. So while we know, what the interest rate might be, this year, we don't know what the loan rate, might be next year or any of the years after that. So we like to show a varying loan interest rate to demonstrate that this is a variable that needs to be accounted for. All right, so let's take a look. What do the numbers look like here? So we have a total loan amount of $8.7 million. In year 17, we're going to show the trust repaying the lender by taking a withdrawal from the policy cash value of that same amount, that $8.7 million. Because we use the return of premium rider and the death benefit will be reduced by the amount of the withdrawal, it brings the net death benefit back to the desired $20 million. The remaining policy cash value is illustrated to keep the death benefit in force for lifetime. So the total out-of-pocket cost is just the total interest paid, and in this case, it equals approximately $4.4 million of interest over those 17 years. The IRR using this premium financing technique is 5.71% at life expectancy. So now that we've seen a premium finance case study using the policy value as the loan exit strategy, Joe, can you tell us a little bit more about some different kinds of commercial premium finance designs?
Sure. What we're going to talk about now is the use of what we call the minimum premium design, which has gained momentum recently due to the low rate environment. This protection design approach will increase the IRR on the death benefit return due to the spread between the low premium, the low lending rates, and the assets return rates. Now, funded ILETs that have high yield investments such as real estate, securities, or gifts of such assets are perfect for this type of minimum premium design. Now, when using this minimum premium design, the use of the arbitrage between the asset return rate and the low lending rates basically creates a discount on the total cost of premium and can reduce the total amount of gifts made to the trust to fund these large policies. Now, what differs with the minimum premium design as compared to the overfunded is with the minimum premium design, we need to consider what is the exit strategy or loan repayment strategy, because that's going to be held outside of the policy. Typically, what we see is the use of existing or gifted assets used to repay the lender, or with the historically low 75/20 rates, the use of grantor retained annuity trusts have become a very popular exit strategy. So let's take a look at an example. Here we're going to show 2 ways to retire the loan after 10 years using a minimum premium funding approach. We have a joint life protection SIUL for clients age 67 and 65 for $20 million of death benefit. And again, we're going to assume a 5.67 return on the core capped index account with vitality set to bronze. And the premium, to 10-pay premium solve, here the minimum premium is $449,000 per year. So the total premiums due over that 10 years is about $4.5 million. The loan rate we're going to illustrate here is the same 2.5% using increases of 20 bips per year. Now, the IRR on the premium stream inside the policy is 6.48%. Now, with that background, let's look at 2 ways we can place the policy using the lowest possible premium and build in this repayment strategy. One exit strategy you're going to see in the first design will reflect an upfront gift of about $2.8 million, and the other, the use of a grantor retained annuity trust. Okay, now, Using the upfront gift, if we assume that gift of 2.8 million returns 7% annually, the income and growth on that asset will be sufficient to pay the loan interest annually over the 10 years and repay the lender the $4.5 million due on the loan. So the lender is going to loan the $450,000 each year. This gift is going to be held in trust, and the income from that trust is going to pay the interest. The upfront gift of 2.8 reduces the total out-of-pocket cost by over $1.7 million as compared to the client making gifts of the $450,000 premium. So as a result of that, the increase in the IRR to the heirs on the death benefit increases to about 7.25% at joint life expectancy. Now, given where we are with the high estate tax exemption and the concern about estate tax reform, there's going to be clients who are going to be in a good position now to take advantage of the high exemption and make the gifts now, and then use the income and then leverage that income by using a minimum premium finance design. Now, let's take a look at the same case where we use a GRAT for the repayment strategy. Now, this technique is best used for the type of client that wants to preserve their gifts or has used their gifts and or has hard assets such as business interest or real estate. Now, in this design, again, the lender is going to loan the $449,000 of premium. But the client is going to create a GRAT and transfer about $8.1 million of assets into a 10-year GRAT. Now, let's assume that GRAT asset returns 7%. Now, each year, the grantor is going to receive from the GRAT an annuity payment of about $830,000, or $8.3 million over the 10-year term of that GRAT. So basically, they get their entire asset back through the GRAT. Now, one difference here is that the client will have to make gifts of the annual loan interest each year. So in the first year, the client's going to make a gift of $11,000 to the trust to pay the interest. Over that 10-year period, the total gifts of interest is going to total about $870,000. Now, when you compare this to the prior minimum premium design, that's going to reduce the total gifts by about $2 million. Now, what's even better is the remainder portion of this GRAT is going to be the ILET. Now, the ILET is going to receive the $4.5 million remainder interest from the GRAT and is going to use that to repay the lender in year 10. Now, what's amazing here about that transfer of $4.5 million from the GRAT to the ILET is that the gift tax cost of that transfer is about $4, or the cost of a cup of coffee. So you can see how, from a gift tax perspective, the use of a minimum premium design and the use of a GRAT can be of interest for the right type of client. Now, advanced markets, we have many tools and client-facing material that can help you create the most efficient asset design possible for your client. We just showed you 3. There are certainly more variations or combinations of these types of designs that we've just showed you. And our role here is to work with you to determine which is the best way to put these together. Martin, maybe you can go over some of the tools that are available.
Yeah, absolutely. So thanks, Joe, for going through that. So we do have a whole host of different materials, marketing materials and client-friendly materials and, advisor materials and everything else on premium finance. So, here we've highlighted a couple of them. The first one here is the premium finance illustration in JH Illustrator. So this was just recently added to the desktop version of JH Illustrator. So if you do have that, you can run these cases yourself. But feel free to reach out to any of us on the advanced markets team, and we'd be happy to help walk through how to run those illustrations, or we'd actually help with the case design and help run those illustrations for you. The next one here is we have our finance guide that was put together a little while back. It's a great resource on the various different financing techniques, and including a section on commercial premium finance that goes over a lot of the things that we've discussed today. So another great resource there. We also do have a client guide that is a client-facing piece that is, if you ever need to, provide some additional information on your client on the premium financing topic, it's a great resource there. Additionally, we do have our financing guidelines that include all of the underwriting pieces and answers, many of those questions as well. So again, the advanced markets team, we're here to help with any of your premium finance designs. We can help run those illustrations or walk you through how to run those illustrations. So feel free to contact us at the number on the screen here if you have any questions or need any help with your designs. So with that, let me stop the recording and we'll get to the Q&A portion. Give me